Today we're looking at 4 undervalued dividend stocks with up to 66% upside. We're going to take a look at this Morningstar article which talks around 10 of the best blue chip stocks to buy now in the long term. We're going to run through the list. We're going to pick 4 of our favorite ones. We're going to run through the historical performance of each one as we usually do on the channel. We'll take a look at their dividend safety, take a look at their financial metrics, see whether or not these are very strong companies to hold. And as always, we will run them through our valuation model, getting to the intrinsic value as well as the acceptable buy price, given that investor margin of safety, and see what the price target is for the next 12 months. Now, the first one that we are looking at today is RTX. Now, this is one that they do believe to have large value. We can see the trailing 12-month yield at 2.73%. And for those who don't know, they operate in the industry of aerospace and defense. Now, they do believe it to have some significant discount, as we can see here, 24% with their target of $112. So let's take a look at RTX Corporation. Now, over the last year, they are down around 10%. They are trading pretty much in the midpoint of the 52-week range with a forward yield of 2.61%, forward PE of just under 17, and investors who have been holding this company over the last 10 years, well, you would be up around 30%. Now, remember, it doesn't include those dividends reinvested, so it's not the greatest 10-year performance, and we do see its all-time highs around April 2022 at $105 or just under $105. In terms of dividend safety, we have a score of 70, market cap 130 billion. It is a mega cap company. In terms of those recessionary metrics that we love to see, well, they maintained the dividend in the last recession, average growth of around 11 to 12% negative, and they essentially had a near S&P recession return, negative 52% versus the S&P's negative 55%. In terms of dividend growth, well, nice to see last April, 7.3%. It is above the essential inflation rate that we always advocate on the channel, 4% or more. But do bear in mind, over the last 5 years, we are seeing a negative 4% as they did have a dividend cut. And over the last 20 years, we see a 7% year on year. Something just to bear in mind, so they have only been increasing those dividends for the last 2 years. In terms of dividend yield theory, for those viewers that are new, essentially states that the company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation, 2.6 versus 2.38. Bear in mind, though, we don't look at any of these models in isolation. We will draw conclusions towards the end. Forward PE 16.8 versus 19, another sign of undervaluation. And when we compare it to the industrials, Raytheon is still low at 16.8. Now, in terms of the essential free cash flow payout, typically we ignore the earnings. It is susceptible to manipulation by management through accounting. We do run through many examples. One very quickly, let's take a look. In 2020, if you saw the earnings, you would be happy, 62%, not too far off 60. 2020 on the free cash flow, it's showing a truer picture, telling us that management paid out more in dividends than they generated in free cash flow. Moving on to the more recent year, 2023 at 70%, a little bit too high for my liking. The only positive to note, 2024, it is expecting to come down to 59%. Free cash flow per share, well, 572 in 2014, 331 in 2023. We can clearly see it isn't going in the direction we want it to. It is in fact declining. Something just to keep an eye on, although 2024 it is expected to go higher, just shy of $4. Sales growth 3 to 7%, steady revenue as a very minimum for any company. Now, very interesting, we see a strong year of negative double-digit growth at 2018, although from that point it has returned strong double-digit growth to the top line for the next 3 years. The last 2 years in that 3 to 7% region, not the worst, but it would be nice to see back up that double-digit revenue we have seen, something just to consider. And we see the movement over the last 10 years, 58 billion to 69. Shares outstanding, we love it as investors when companies return excess cash to shareholder pockets. What Raytheon have actually done is the opposite. They've diluted your position, as we can see. Your position at 0.912 shares outstanding has gone to 1.44 in 2023. Just something to bear in mind. Return on invested capital, for me personally, 10% or more is what I ideally like to see, and consistently. The reason for this, it gives me faith management are able to effectively allocate their capital. Over 2014 to 2017, it was nice, but you could see it decline. In the more recent years, it hasn't really got to that 10% level that I personally like to see, the most recent year at 5%. Margins, operating margin, they have struggled. Again, these are things you should just be thinking about as you are looking to invest, or if you're an investor in your investment thesis. Not only is it below that 12% over the more recent period, but it has started to decrease. Free cash flow margin, on the other hand, the last 3 years, pretty consistent at that 7% level, which is above the 5% minimum we like to see. Net debt to earnings before interest, tax, depreciation, amortization. More for the newer viewers, it signals two things: dividend safety as well as balance sheet strength. These are the number of years it would take the company to pay off all of their debt net of cash on hand. Something just to bear in mind, 2.95, pretty much near that maximum 3. 2024 it is expected to go lower, so for now the balance sheet looks to be okay. The dividend does also look to be safe. So let's take a look at the valuation model. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we do run through every single one of these models to get to the intrinsic value. For today's episode, let's just jump into the intrinsic value for Raytheon, which comes to $106. Now, the current trading price at $91, we start off a margin of safety at 10%, and we use this if we believe it has a wide moat, strong financial metrics, and good forward-looking data. At 15%, it is pretty much a few cents shy. So for Raytheon Corporation, we see around a 15% margin of safety. In terms of Wall Street and what they expect, well, they have a price target of $112 with upside of 24%. So they do see this as a fairly strong buy. As we go through these stocks, do let me know in the comments below as or not whether you are adding any of these companies. The next company which remains to be heavily undervalued is Roche. Now this is one, as we can see, is a drug manufacturer with the general region. We see the trailing 12-month yield at 3.6%. Again, a large style blend, and we can see some severe undervaluation with Morningstar seeing it trading at a 40% discount and fair value of $59. So let's take a look at the company. Over the last year, it is down 9%. It is trading towards the mid to lower end of the 52-week range. Forward yield 3.6%, forward PE 13.4, and if you've been holding this company over the last 10 years, you would be flat on your investment, and we can see all-time highs of $53 in April 22. Dividend safety, very nice, 99 score, the highest score possible to achieve. Market cap 231 billion, a mega cap company. Recessionary metrics, well, they increased the dividend during the last recession. Above average growth, negative 4% as well. In terms of dividend growth, not the greatest over the last full year, below inflation. The same can be said for the last 5 years. Last 20 years at 10%, it is nice to see that double-digit growth, but it is something we want to see in the more recent period. And we do note they are a dividend aristocrat. They have increased those dividends for the last 25 years or more. In terms of that undervaluation signal, we have a double signal, the yield currently above the 5-year average and that forward PE below the 5-year average. And also, it is also below the healthcare sector PE at 18.1. Let's take a look at the free cash flow payout. Below 60%, remember, is what we are targeting. 2021 and 2022 below. 2023 expected to hit that 60%, and 24 expected to go lower. Overall, looking at it consistently around that 60%, something that I am happy with. I can live with that, as that is personally my maximum. Free cash flow per share, we can see here $15 in 2013, $17 in 2022. There aren't consistent increases, but it is increasing over the last 10 years. Although you could argue with that 2023 expected at $15.90, there isn't any real movement. In terms of sales growth, well, it is important to note 2023, they are expecting a drop of 7% to the top line. But other than that, and the COVID year where we see negative growth, more often than not, they do achieve the 3 to 7% growth on that top line. Total sales, then, it has gone from 49 billion to 66. Share buybacks, it is something they have done, buying back nearly 60 million worth of shares, just under 10%, but it isn't very consistent as we can see. And in fact, up until 2021, 2020, they were doing the opposite, but the net position, as we can see, is a share reduction. In terms of ROIC, phenomenal. Remember, 10% or more, we're seeing very strong minimum in the mid-30s, 2023 at 34%. It is something we love to see on this channel. And margins looking very strong. A bit of a difference to that previous company, Raytheon, that we analysed. Phenomenal operating margin, consistently high, as well as that free cash flow. Net debt to EBITDA, phenomenal as well. 0.76, 0.95 expected in 2023. We can see why that dividend has a very safe score, and the balance sheet looks to be very strong as well. So let's get into the valuation of Roche company. And as always, if you do want to grab a copy of the valuation model to get to the intrinsic value as well as acceptable buy price of companies in your own portfolio, then do click on that pinned comment below. Margin of safety at 10%, it does remain to be a buy. At 15%, a buy. And at 20%, we can see it's still there. 25%, it is nearly there. It's just under $1 shy. So we do believe there to be around a 25% margin of safety for this company. In terms of Wall Street and their forecast, well, they see 66% upside, a strong buy with that target of $59. Now, moving on, just to let you know, before we run into the next company, we have done a free weekly newsletter. The last letter we sent out was relating to undervalued companies with some strong upside, and the first ever one we ran through our golden dividend metric screening for undervalued companies. Completely free. If you want to sign up, just click on that pinned comment below. So let's jump into the next company. It is Bud. Now, this is one which is a beverages brewer industry, trading 12 months of 1.31%. And we can see that Morningstar have this at a 30% discount with the fair value at $90. In terms of the performance, well, over the last year, up 4%, trading in the mid to upper end of the 52-week range, trading 12 months, as we mentioned earlier, and a forward PE just under 21. Over the last 10 years, though, they have been declining, down 36%, although it is important to note that doesn't include those dividends reinvested. Market cap sitting at $123 billion. It is a mega cap company. Dividend growth will last full year extremely high at 41%. It is important, though, to note that they did have a dividend cut, and over the last 20 years, it has been on average increasing by 5%. In terms of those financial metrics, then the free cash flow payout in the more recent period has been very low, as we can see here, 20% in 2022, 22% expected once that 23 annual report is released. Free cash flow per share, not the greatest that you want to see. It has been decreasing over the last few years. 2023 expected to go lower, although 2024 it is expected to pick up to 414. Sales growth very mixed. We do see some years of negative growth in the more recent period. Double-digit growth in 2021, fairly decent in 2022, and 2024, or 2023 in fact, is seeing a 4% increase to the top line. Numerically then, 43 billion to 58 billion. Shares outstanding, it is also important to note they have done share issuances, so your position in this company over the last 10 years, you would have been diluted. ROIC consistently in the more recent period around that 8%. It isn't the greatest. Personally, 10% is what I want to see, but again, it depends on your investment thesis. I'm just talking about my own style. A lot of people may be happy with that 5 to 8% level. Operating margin and free cash flow margin, I think there's a similar story to be told on both of these. They are very positive even in the more recent period, but they have been declining. This is something that I would just urge investors and potential investors to keep in mind. With margins declining, it is a bit of a worry as to whether or not they will stabilize and at which point. Net debt to EBITDA below 3 is what we want to see, so a little bit too high for comfort, 3.6. 3.77 expected in 2023, so I would keep an eye on this if this was a company I was looking to invest in or investing in. So moving on then to the valuation of this company, which Morningstar do like, we can see that the intrinsic value for today's episode is coming to $106. Now, when we take a look at that margin of safety at 10%, it is a buy. 15%, pretty much a few cents shy. So we see a 15% margin of safety with Bud. In terms now of what Wall Street have, they have a 24% upside scenario with that price of $112. As always, let me know if any of these are any of interest to you, as we have taken them from Morningstar's most recent article. Moving on then to the next company, we have Sanofi. Now this is one, again, drug manufacturers general with a yield trading of 3.74%. And we can see here, they do believe a 17% discount with that value at $61. Now over the last year, it is up 3%. We can see it in the middle of the 52-week range with a forward yield of 3.8 and a forward P of 11. Over the last 10 years, well, you would be fairly flat on your investment, and we can see it has hit its all-time highs a few times over the last 2 years at around $58. Now, taking a look, dividend safety looks to be very safe at 90, market cap $125 billion, a mega cap company. Key metrics, well, they increased the dividend in the last recession, above average growth, and also outperformed the S&P, negative 42%, versus that S&P's negative 55. Last 4 year looking positive at 7%. Last 5 years are more of a dampener. Last 20 years though at 7%. It is nice to see, and hopefully that will continue. And they are 2 years away from becoming a dividend aristocrat. Now, in terms of that dividend yield theory, we have that sign of undervaluation / reasonable valuation, when the same to be said on that forward PE. And when we compare it, the healthcare sector PE is still significantly higher. Now, let's take a look at the free cash flow payout. 60% or lower. It has been straddling along that for the large part of the last 10 years. Nice to see 2022 and 2023 expected to be below the 60% level. Now taking a look at the free cash flow per share, it has nearly doubled, or in fact around 50% growth to be honest, 427 to 665, 2023 expected to be fairly flat on the previous year. Sales growth, well, very inconsistent. In fact, it seems to follow the trend of 1 year negative growth followed by 1 year positive, although the last 3 years aren't looking too bad for this healthcare company. And numerically, we can see it has pretty much grown their top line 50% from 31 billion to 45. They also do share buybacks, as we can see here, with the shares outstanding decreasing, although it isn't too much to warrant much of an explanation. ROIC, nice to see around that 10% level for the large part of the last 10 years. 2022 and 2023 at 11% is nice to see. Now, margins, very nice. It is what we expect from these type of companies in this industry. Some nice high margins and free cash flow margins. So nothing really to note here, nothing bad. And on the net debt to EBITDA, 0.71 in 2022, 1.02 in 2023, looking fairly positive in terms of that balance sheet strength and dividend safety. So let's take a look at the valuation of SNY, and the intrinsic value in today's episode is coming to $65. Now, current price at $50, we start off with a 10% margin of safety, 15% at 55, and a 20% at 51. So we can see it's not at a 25% level yet, around that 21% up to $52. In terms of Wall Street, well, they forecast around $61, that type price target, with an upside of 22%. And finally, for those who want to know what the other 6 stocks were, we have them here on the screen. We have Pfizer, which we have reviewed recently, as well as Comcast, Nike. We have Taiwan Semiconductor, Medtronic, Bristol Myers as well. So do let me know with any of these you are looking to pick up, whether you do believe there is some strong upside with these companies, or for whatever reason you don't quite like them or their financial metrics, as we did review some that had some metrics that you should bear in mind before investing. As always, if you enjoy the content, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. As always, have a great day, catch you on the next episode, and take care for now.